Good morning, everybody. It's Uncle Bruce here. Stock Markets with Bruce. Good morning, one and all. This is Thursday, May the 20th, 2021. If I buy one call at 17.50 and it goes in the money, I will then need 17.50 to purchase them, correct? No, you do not. Theoretically, if you buy one contract at, say, $2 or $4, and the stock goes up in price, and the contract is now worth $8, you just sell the contract for $8. You don't have to exercise it. You don't have to come up with $1,750. You don't buy the stock from the option seller. You just resell the contract in the contract market because that's where you're getting it from. You're buying the contract in the contract market, the options market, and you're selling it in the options market for whatever the market is telling you it's worth. The higher the stock goes, the more the contract is worth. And if the contract is purchased at $4, it's a $400 purchase because it's a $4 a share times 100 shares per contract. That's a $400 buy. If you're buying the contract at $5, it's a $500 contract. If you buy it at $3, that's $300 to buy. You sell it at $6, it's $600 to sell. You made $300 profit. You took $300, turned into $600. And if you got 5 of them, you've turned 600 into 3,000, obviously, because you have 5 times 6. That's how this works. Thank you, everybody, for that. The options market. Now you know why people hire me for an hour on these private consultations. We get through these theoretical chats on options and how they work, and then I talk to you about how to write contracts on stocks that are doing, rather nicely. How you can bring income in while you're holding paper, and this is the other side of the story for IPOE. Buy IPOE right now at $17.60 and sit on this stuff. And if it does go to 35 or $50, you can then become an option writer. And I will help you with that. Now you are writing contracts against every 100 shares you have. So for $1,760, you can buy 100 shares. There's no expiry on the 100 shares. You don't have to worry about that. Of course, if they go to $50 a share, $1,760 turns into $5,000. Are you rich beyond your wildest dreams? No. Did you make 15 times your money? No. Is it conservative? Kind of, because you're buying at 17 on a company that's a $27 book value, hoping it goes to 50. But at $50 a share, you could theoretically now become an option writer where you are selling a call contract against your 100 shares for anywhere from $200 to $400 for maybe 1 month of time. So every month or so, you can bring in $200 to $400 a month on your investment by just offering your stock for sale at, say, $55 a share for a month or so. They don't go beyond that, and they just sit between 50 and 55. You bring in between $200 and $400 every 30 days on 100 shares, a $1,700 investment. You're bringing in $200 to $400 a month on a $1,760 investment. That's a pretty good return on your money. Do that every month for a year, and you're bringing in more money than you put into the market, and you still own the stock. Maybe you may want to talk to me for an hour, have a private consultation. FAII has no call options on TD Ameritrade. They all show bid ask at 0. What up with that? Actually, only August 20 offers at 90. Where are the other dates? Okay, it's not odd in that there probably are options available, or let's put it this way, options are eligible to be traded on this stock, but market makers need to be motivated to make a market, and they haven't gotten around to it yet because they're looking at this going, there's no serious interest in this deal from an options point of view so far. So in theory, there's not much happening. Now, theoretically, in theory, maybe you might be able to enter a buy order on a contract that has no open interest at this point in time. And you might be able to put in a bid for like 20 cents or something like that for a $10 call for January or something like that. And you won't get it, but it might spur a market maker to make an offer. And they might offer it 50 cents or 80 cents or something like that. I don't know. And they might make a 50 to 70 cent bid ask. I don't know. But until orders are coming in from the outside, the market makers are hardly going to get involved with a very quiet issue. So you're probably better off buying the stock, FAII, and you can get it around the $9.90, $10 mark, and get your hands on it. And then let's see what happens with the options down the road. But eventually it'll happen. does each broker have their own contracts, or are the option chains the same everywhere? If I write a contract on Fidelity, can someone in Robinhood buy it? Good question. There is no stupid question, and this is a good question. I hadn't even thought to bring this up. The option chain you're looking at is the option chain from the Chicago Mercantile Exchange. It's the same for everybody. So if you buy a call contract through Robinhood, you could be buying it from a seller on Robinhood, or you could be buying it from a seller on Fidelity or Schwab or JP Morgan, or you could be buying it from a market maker, the option market maker in Chicago. You don't know and you don't care. And the same thing when you're on the other side of the trade, whether you're writing the call, buying the call, selling the call, buying it back, rewriting another one, it doesn't matter. You are going to the Chicago Mercantile Exchange in almost all cases. Almost all options trade there. The vast majority of all the contracts trade there. And you don't have to worry about who's buying, who's selling, and how you're doing it. There are no different prices for contracts anywhere else. This is just like buying and selling the stock on the open market. When you looking in your phone or on your computer and you want to buy a stock or sell a stock, the bid ask you are seeing is the best buy price and the lowest sell price at that moment in time you're looking at, and you watch it shift all the time. Same with options. Options also do the same exact thing. Now, if you are buying and selling contracts in a very heavily traded stock, and the options are that you're looking at are right around the exercise price, or right around where the stock is at, you will likely have a lot of volume on the contracts and on the stock all the time. So something like Apple trading at, say, 124 a share, if you were to try to trade the 124 contracts or the 125 contracts, you'll likely notice the bid and ask on an Apple contract where it's at the money, the spread might be a dime, might only be a nickel. So it might be like 240 to 245, or 315 to 320, and last trade at 315, or last trade at 318. They might trade in pennies, and their spreads are like nickels, dimes. Whereas if you're trying to buy and sell a contract on Apple when the stock's at 124 in the open market, and you're trying to play a contract at 150 for, say, 3 months from now, the spread might be 25 cents to 50 cents. It's a lot wider, and it's not as active a contract because it's not at the money where the action is right now. But there's still a market for it, and sometimes the market is purely made by the market specialist, the market maker for Apple contracts. Other times, the buy is the market maker, the sell is a customer. Sometimes the buy is a customer, and the sell price is the market maker. It varies. Doesn't matter. You're always shown the highest possible bid price, the lowest possible offer price, and of course the last trade. And trading can be done by any and all. I buy 5 $3 Ipoe calls, strike price $20, expiring January 21st, 2022. I spend $1,500 for the stock, for the stock worth $10,000, right? So if it goes to 40, well, my contract will be worth $40,000. In that case, did I really make $38,500? Oh my gosh, no. Okay. If you're buying 5 call contracts that have an exercise price of $20 each, good till January 2022, you are paying $1,500 to buy 5 contracts. Okay. If the stock goes to 40 anytime between now and then each contract is $20 in the money, because it's a $20 exercise. It's trading at $40. The difference is $20 a share. You're $20 in the money. Each contract is worth $2,000 in actual book value. You got 5 of them, so they're worth 10 grand combined. You can just sell the stock. You can just sell the contracts on the open market, and you will get at least $10,000 for the sale of your contracts that cost you $1,500 to buy. Okay, you didn't make $38,500. You put up $1,500, and you turn $1,500 into $10,000 plus some time value. Maybe you'll get $11,000 in total. You made $9,500 profit on a $1,500 investment. Nice return on your money, by the way. if you just buy the stock right now at 1868 and it goes to $40, you make a profit of $21.32. $21,300 in profit on 1,000, 2,100 on 100. So you can either make $2,100 on 100 shares, which will cost you $1,800 to buy, plus 600 more, or you could take $1,500 and turn it into $10,000 or $11,000 on the contracts. You make more money on the contracts because you're controlling 500 shares. 5 contracts, 100 shares per contract. Except the risk is that if the shares don't go to 40 and they stay at 25 or 22, you'll be making some money on your contracts, but you might take $1,500, turn into $2,000 or $2,500. With 100 shares at 1864, you have no expiry date. You don't have to worry about when those contracts are exercisable at. It's an 1864 purchase right now, and if it goes to 2864, you make $10 a share, which is $1,000 on 100 shares. It's $10,000 on 10,000 shares. I mean, it's all up to you. 1,000 shares makes you 10 grand. 10,000 shares makes you 100 grand. How many dollars have you got? How much risk do you want to take on? And so on. I say to those of you who have a little bit of money, you can get yourself 5 call contracts like these right here, and you can control the upward gain of 500 shares. You can enjoy the upward gain of 500 shares for $1,500 up front. So, like we say, if they do go up in price over $20 a share, every dollar after that, your call contract is $1 a share more valuable every time your stock goes up $1. But since you are controlling 500 shares, you get $500 wealthier in book value on your 5 contracts because they're exercisable at $20. If the stock goes to 22, 23, 24, every dollar is 500 more for you. That's the leverage you get for a $1,500 wager by controlling or owning 5 contracts that expire next January. So between now and next January, these shares go to $100 a share. Let's hit the jackpot. They go to $100 a share. These call contracts will be trading at about $80 a piece, or $8,000 a contract. $80 times 100 shares is $8,000. You've got 5 $8,000 contracts. $40,000 is what they're worth. You paid $1,500 to buy them. You don't have to exercise them. You can sell 1 contract at a time on the way up if you want. You can sell 2, 3, all 5, up to you. So if the first contract, you sell it at $12, that's $1,200. The second contract, you sell at $22, there's $2,200. The third contract, you sell it at $38 because it's just killing you. You $3,800 more. The fourth contract, you sell at $50, $5,000 more. And the last contract, you sell at $82, $8,200 more. Add it all up, you made money, 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 money. If you kept them all, of course, but you tell me exactly what the top price will be, what date it'll be at, and all that. Good luck. But hey, you need $1,500 or more, or $3 a contract or more to make money on this bet. And that's what this is. It's a wager between now and January the 21st of 2022. That's 8 months from now, approximately 8 months. I like your chances of making money. I really do. I like your chances. Exactly how much you're going to make and when you're going to make it, can't say. What I can say today is the stock is at $18.62 right now, and it's up $1.19 today now. All the options of Ipoe have gone up in value today. Not all by $1.19. They vary depending on how far out of the money they are, but they've all gone up in value today. They're already showing you that the options will move with the stock. But this stock, in my opinion, as SoFi in a week and a half, is not going to be around here. SoFi merged into Ipoe. The analysts have already pegged it at a $27 book value company upon merger completion. Now, will the stock behave itself and trade at 27 or more when that happens? Or will it take a while? Or will it go beyond 27 already quickly? Will it go to 30 in the first couple of days of listing as a new SoFi company? If it goes to 30, you got a $20 call. Your calls are worth probably $10 to $12 a piece. They're $10 book value plus time till January. They're probably going to trade at $22. Or $12, I should say. They'll be worth $12. And so you've quadrupled your money. You've gone from $1,500 to $6,000 right away. That's in a week and a half. Is there anything wrong with that? Anybody got a problem with that? Hands up, and you're excused. Get out. There you go. Anyway, let's see what happens. Fun times. Thank you, everybody, for that. If you'd like to talk to me about a 1-hour session, you want to get together with me, send me an email through my email address, which is right here. It's the old school hotmail.com email address. Send me an email. Say, Bruce, I'd like to talk to you on a one-on-one session. When can you book me in? I'd like to make a reservation and lock it in right away.